Hey, Wilf, yes, this was long anticipated, really called for by market participants. This one concerns the commercial paper market, which is where companies go to fund short-term liabilities and go in and they get working cash, really, for all kinds of things, very essential for the working of the financial system, for the workings of businesses, even for households as well. So what happened is they launched this commercial paper funding facility, which is very similar to what they did back in 2008. In this case, however, a little different. The Treasury is providing a $10 billion backstop to the Fed. Hold on to that thought because we'll come back to it in a second. And the Fed, I'm told this could be up to $700 billion in commercial paper that is financed at this facility. Now, reviews in the market have been mixed. I've been on the phone all afternoon since this facility came out this morning with different guys or different folks in this market, and I want to read you some of the reviews that we're getting. One senior market participant said, it's too punitive right now. Nobody's going to use it. The commercial paper market is still not functioning well. What he means by punitive is the rate the Fed is charging for these loans is above where the market is right now. So they're looking for the Fed to adjust that. Indeed, another market participant I talked to had another idea, said, hey, the Fed is doing the best job it can given how quickly circumstances have changed. This person points out, hey, 2 weeks ago, nobody was talking about the kind of numbers or the kind of declines that we just saw Bob Pisani show and Mike Santoli show on the screen there, and how quickly the economic situation has changed. This person believes the Fed could eventually adjust things, also thinks the market will eventually come around to it. Finally, Krishna Guha at Evercore ISI has this point of view. He used to work at the New York Fed during a lot of the crisis, said this is a necessary step to stabilize short-term corporate and financial funding markets. But he goes on to say, the structure of the new CPFF makes it look as if the Fed is being more conservative in its own risk management than it was in 2008. So we'll see, guys, if the Fed adjusts this, if this has a positive effect. Right now, it looks to be kind of neutral. I didn't hear, when I talked to people, any improvement in that market, though other things the Fed is doing has nudged some things a little closer, but they're still very wide in terms of the spread of where they should be trading relative to normal times. Wilf?
Steve, that's really interesting. I'm just going to add a bit more color as well. I've been speaking to a couple of executives and market participants myself, starting with a top high-level bank executive that I spoke to in the last half an hour. And I'll address, first of all, that other story, Steve, that we were talking about earlier, that the banks decided to access the Fed's discount window, another source of liquidity. This senior bank executive said that not all banks wanted to do that initially, mainly because of the fear of the political backlash of it being framed as a bailout. But the Fed pushing the group to do so was a game changer. Once some were on board, they all were. And things moved pretty quickly on that front yesterday. This wasn't part of the buyback announcement over the weekend. It was a yesterday afternoon to evening decision. Now, also, just to address what this bank executive said in terms of the Fed's actions that we've seen today, said the Fed is really listening and moving quickly, as you alluded to as well, Steve, that they've taken the action that was needed and addressed the plumbing in the repo, treasury, and commercial paper market, all of which is encouraging. That said, Steve, I also spoke to the head of trading at one of the top investment banks here in New York, and they said that's meant that markets are functioning better, but only a smidgen better. Those were his words. And some key investment grade bonds have got away and that they've cleared, and that's encouraging, but commercial paper itself is not yet. And just one final point, Steve, that he mentioned was that as banks continue to lean into work from home policies, that is adding to these liquidity pressures because, as he said it, that trading floors are an ecosystem and a beehive of activity, and if you've got some headcount from home, it's making these liquidity issues worse.
Wilf, let me just back up and tell viewers why we do this the way we do this. These are not markets that you can really cover the way you do a stock market where you can show a decline like that. There aren't really good graphs. And by the way, when these markets get gummed up the way they are, there really isn't pricing out there. So that's why your reporting, my reporting are the way that we report this story, not in the charts and graphs that can show you very obviously what's going on. I could show you a graph, by the way, of the huge decline in money market funds and prime money market funds or the assets in them. But first of all, what you said to the discount discount window sounds a lot like what happened back in 2008, where they brought everybody in, or I guess it was 09, and they said, you will take this money from the TARP, even though guys like Dick Kovacevic and others didn't want it. It was an offer they couldn't refuse because of the optics of it. They want to show everybody going, because if one doesn't go or two don't go, the others look weak. That's very important. And then I think your reporting is backing up mine, that so far there's only been a nudge. You used a smidge. I said a nudge in some of these markets. What somebody told me, Wilf, is that the Fed is going to have to come in and make purchases in a bigger way than it's done already.
Steve, we'll keep an eye out for that. Thank you so much.